Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again that most frequent guest on this show, Michael Oliver. Thanks for joining me again, Michael.
Always good to be back.
Always good to have you, and let me remind our listeners again, it's Oliver MSA, olivermsa.com, to follow what Michael's doing to learn more about his excellent service. Michael, in your weekend report, you stated that trading on Friday was informative from the standpoint of view of a short-term momentum. But if I understand what you meant in an email you sent to me earlier today, you were suggesting that the markets are in the midst of a huge battle to determine future direction. There is seemingly an ambivalence that is leading to a lot of investor anxiety. Certainly I'm feeling it in many ways in the equity markets and the precious metals markets. And you said that when these kinds of battles are resolved, though, they usually see a more, let's say, a longer-term direction, and it's usually different from where they've come from. Is that right?
Yeah, I think that, congestions can be argued in price when the market's moving in one direction and goes into a congestion phase. It could be a rest stop prior to higher prices or in a downtrend toward lower prices. But after protracted bull trends or bear trends, multiple years, and then you get that behavior, just on the surface of price, without even looking at momentum, you should be a little more cautious about that congestion being potential for a transition the other way, not a congestion for further gains. Mm-hmm. When I mix into that my the MSA's metrics on momentum, and we measure everything from daily, weekly, monthly, quarterly, annual, so forth, for measuring all kinds of time scales. Everything flashing to me says, no, this is topping action in stocks. We're in a bottoming process in gold. We're likely in a topping process in T-bond prices over the next 6 months or so. And in the case of the dollar, we're likely in a topping process. Now, this does not preclude these constant give and take, confusing and frustrating actions by all those markets. Where 2 weeks you look at gold, it's up nicely, and it's back where it was 2.5 years ago, namely 1178. Or 2 weeks later, all of a sudden you're down, under 1100 again. Or in the stocks right now, for example, today in the trading, we traded a price of 1071 at one point during the day. You can go back a year ago, we were exactly at that same price a year ago, the same week. Mm-hmm. So you're getting the kind of action that should drive people nuts, and both sides. Both the longs get frustrated, and the potential shorts get constantly whipped out of their positions. And I think it's time to sit back and realize that that's the nature of what these major markets are involved in right now, are huge transitional congestion zones that I argue are going to resolve in opposite directions to the prior trends.
Mm-hmm. That's what you'd expect from history, I guess. But it's hard to when you've been experiencing a bull market for so long in stocks or a bear market so long in gold, you get the feeling eventually that throwing in the towel, capitulation, I guess it is. And so what sort of signs? I know your momentum stuff really gives you a heads up a lot sooner than the price does in many instances. Is your momentum indicators giving you any sense of anything, or is just basically saying?
I reverted recently to short-term momentum, and because a lot of clients were wanting to see what about the next 3 days, instead of the next 3 months, and but that's the nature of this market. So I did it just to more or less scratch that itch for them. And the S&P closed yesterday a little bit too low. It looks like it's under, its near-term pressure could continue a bit. And again, we're talking very near-term, so it's really meaningless information. I'm arguing. Gold, I had a number for today at 1095. They were at 1094.80, and I want to close up there, and they're not gonna, obviously. So to turn it up for a trade. But frankly, that's not really the issue. The issue is, I think, getting into next year, because a lot of the numbers will change then. Quarterly and annual momentum numbers will change because the averages change. And at that point, I've come to the conclusion myself that don't be frustrated over the next, it's 35 trading days left in the year. Don't be frustrated about the ups and downs of the next 35 days. I think most of these markets, the big markets, the ones that perhaps have not yet really moved in price in an obvious way, are positioning so that in 2016 you'll get a move that will be clear on price. Now, we have to put a caveat on that, and the caveat is a lot of these markets on momentum have already indicated that intended direction, especially on the S&P, and that's down.
Mm-hmm.
Gold has a momentum situation, a structure on its momentum charts that if you saw the momentum charts that I issue on gold and compared it to what you see on a price chart, you'll be stunned by the difference. The momentum has clearly got a massive basing pattern, despite the gradual erosion in price over the last 2 years. And it is gradual if you'll be objective about it. Whether we're going to go like some people think to 1,000 or 800 or whatever, I tend to think not. I think it's still an erosional situation where, the right juxtaposition of a few days' action can suddenly all of a sudden have a $50 rally. And then all that thought of the next decline goes away. We've seen this over the last year or two, repeatedly, where every time you make a new low, we're going to 1,000, and we don't. Maybe we finally will, but so far it's been a teaser. And I think all that process is merely building up the pressure cooker in all these markets for that new reversal and movement in the new direction.
Right. So we're looking for a reversal to the downside in the equity markets and the bond markets too, I guess, probably, right?
Well, we're talking government debt here as opposed to like high yield. So the Federal Reserve and the central banks, the developed market central banks, deliberately wanted to price equities higher and also wanted to push investors out of safe debt and out of savings into high yield debt. They did that. But the high yield market is starting to implode, and it's been coming down steadily in price, rising in yield over the last 6 months or so, to the point where now it's pretty obvious. There's no issue about it. So of the two markets that the central banks basically put their bets upon, they won in both, but one of them is now turned on them. It's high yield market.
All right.
Now then the issue becomes, well, what about the safe debt, the government debt, the 30-year T-bond, the 10-year, the Bund in Germany? Those markets still look safe for a while to me because I think that primarily the reason they're staying afloat, aside from the fact that central banks have more influence over them, but that is that the rattling effect in the stock market, for instance, last August sell-off, or the Bund, the German stock market took a big hit recently as well. So money flew into the Bunds, money flew into the T-bonds for safety. And I think that same movement will continue to occur because I think between now and sometime next quarter, we're going to have another big drop in the stock market, in which case the T-bonds will get another boost. But after that next boost, I see vulnerability in 2016 in the government debt market.
Wow.
The high yield's already broken.
Yeah, indeed, and the charts that you showed in your weekend missive are just really, really make that point very, very clearly. And do you think it's early yet in the high yield markets? There's some money to be made on the short side. HYG.
I'm somewhat a believer in chaos theory, and I think the clock on that could get very fast, very quickly. In other words, whatever low you're going to make there might occur extremely deep, but extremely soon, like in the next 6 months, not the next 2 years. If you get my point.
Yeah.
In other words, how some things move along incrementally in a given trend, and then suddenly there's this whoosh factor.
Yeah.
And a lot of business gets done very quickly. And those people who like to think that markets move in judicious, thoughtful manner, invariably they get proved wrong at some point in the trend.
Yeah.
Where suddenly it's 10 steps forward, not two out of one, so forth.
Yeah, indeed. Well, HYG is a chart that you show here, and of course that's an ETF on the short side. Is that a leveraged or is that a leveraged?
That's a long ETF for the U.S. government. U.S. corporate debt. Then there's TLT, which is a long only unleveraged of U.S. government debt, which is strong.
Right.
So you have one ETF, TLT, which is basically steady to firm. Reflective of 20-year and maturity on out of U.S. Treasury. So it's going opposite. Its yield is declining. Its price is remaining firm while the HYG is declining in price. I think that spread between those two will snap at some point, in which case HYG will have run its course and then the U.S. government debt will join it. Now that's the real issue for the fundamental world. And I know most people don't want to think about this, but how can you possibly add a couple percentage points to long your 30-year debt? And what will be the implications of that to the government's ability to service its debt? Yeah.
Indeed. It's not to mention what it might do to all of the levered trades and the
absolutely
the things that are going on. So it seems to me, Michael, that this canary in the coal mine, so to speak, maybe with this high yield stuff, could be indicating, some let's say tremors in the tectonic shifts that are going on.
It's out of control. There's no question.
Yeah.
I mean, it is not doing what they wanted it to do. It did early, between 2011 through 13 or 14. High yield market performed very well, and so people who followed the Fed's lead and encouragement and effectively the only route they carved for you, if you wanted to invest and earn interest, you were rewarded. But now suddenly you're being destroyed. So it goes to show that markets that are controlled by central banks or heavily influenced don't always remain under that control. People in the stock market need to realize that.
Mm-hmm. Well, I know that, you're a technical analyst. I know, though, also that you're certainly knowledgeable about fundamentals, though I think you're right in suggesting that technicals tell the picture before you can understand what's going on with the fundamentals, but it seems to me that if we're starting to see some weakness in the high yield markets, it's probably suggesting, as I did earlier in the introduction of this show, that things are not all that well in the global economy, and you would start to see it in the weaker debt markets first, where debts can't be paid. We certainly have seen it. Maybe I just ask you in the last minute we have or so here, one of the areas of weakness in the high yield market, of course, has been in the energy space. What are you seeing now in oil? I mean, do we have any upside potential soon in the energy markets, Michael?
I don't think so. I don't think in oil you have upside potential soon. I think the upside potential in oil is likely to show itself in Q1 of next year. I don't think oil is one of the worst places to be in commodities. Even if the commodities, quote, is a basket bottom, and I think they are bottoming. I think some commodities have already bottomed. Some of them haven't because they were latecomers to the downside, to the contractionary situation. Like cattle was a latecomer on the downside, and it's making new lows today. And oil was a latecomer. Most of them topped in 2011. Oil didn't really fall apart until 2014. So it's a latecomer, and it's going to take a while to bottom it. So if you want to buy commodities, that's probably one that should be at the end of the list. It's going to need more work. And by work with quotes around that, for a technician, what it means is time and distance spent building a bottom. It may involve a new low. I can't rule that out. Our recent low was just below 38 a month or two ago. I wouldn't be surprised if we tickle that out before it's over with. I'm not looking for a collapse to $20 oil or anything of that sort. But, another marginal new low below that low in this process would not surprise me.
Okay.
But the upside looks like my bet would be next year at the best. Absolute best.
Okay.
You get in the upper 60s.
All right, Michael, we have to leave it at that because we're out of time. As always, it goes so fast for you. Just to remind my listeners, it's olivermsa.com, olivermsa.com. Thank you so much for being with me again, Michael, and look to do it again hopefully next week.
Good. Thank you, Jay.